Good afternoon and welcome. Thank you for joining us today for the FHLB Dallas Member Perspectives webinar led by Chris Lowe, Chief Economist at FTN Financial. Chris has more than 25 years experience tracking U.S. and global economies, financial markets, central banks, and financial policy, as well as 6 years experience as a money manager. Chris writes daily economic and market updates, weekly economic commentaries, and regular economic forecasts. He's a member of the Securities Industry and Financial Markets Association Economic Committee and the American Bankers Association Economic Advisory Committee to the Federal Reserve Board of Governors, where he served as the 2014 committee chair. He's a regular on Bloomberg TV, CNBC, and Fox Business Channel. Recently, Chris was recognized by Bloomberg as the most accurate forecaster of Treasury note yields in 2014. Please welcome Mr. Chris Lowe.
Thank you very much for that nice introduction. I have the unenviable task of filling you in on what the Fed is going to do, not just this year, but going forward. It's a low-rate, low-inflation world, and one of the biggest, most important developments of the last year is the collapse of oil prices. That is sending ripples around the world, but it is also affecting the U.S. outlook. We start with a glance at inflation globally. On this chart, you can see negative inflation in the U.S., Europe, Switzerland, and very low inflation, near zero in the UK, and even China, briefly below 1% last month, has popped up to 1.5%. But depending on what oil prices do from here, they too seem to be in a decelerating inflation. And partly because of that, global yields are extraordinarily low. Here we're looking at 10-year note yields. You can see that Germany, the black line on this chart, has joined Japan and Switzerland with near zero yields. The UK is still at about 2%, as is the US. Volatility in interest rates in the US this year so far, in January we tumbled, and that was primarily on fears that Greece was going to exit the Eurozone. And in February we came back basically to where the trend was last year. But it is still a declining trend. I think this is going to be one of the biggest challenges for the Fed, that is not only moving long-term interest rates, because obviously they can affect short-term rates, but also interpreting what it means if long-term rates stay low. We know now from reading the transcripts from the period in 2004 to 06 when the Fed last raised rates that there was a great deal of concern on the FOMC because U.S. 10-year note yields were, they thought, stubbornly low. It is for that reason that Bernanke tightened to the point where he killed economic growth and we had a recession in 08. It's not just oil that's pushing prices down. It's also the dollar. The dollar is a very important factor of affecting the economy, and it's not just trade. You can see on this chart in 2010 and 2011, when we were engaged in quantitative easing, the U.S. dollar was weak, and the result was that import prices were rising at an accelerating rate from about 1.5% up to about 5.5%. And note, by the way, these are import prices excluding petroleum. I took oil out because I don't think anyone is surprised that oil prices have fallen, but other prices are falling too. The dollar's been strong since 2011, and prices of imports have generally been negative. That has all kinds of implications for the U.S. For one thing, companies like Walmart, which import a lot of goods to sell to U.S. consumers, obviously they benefit. But consumers benefit in other ways too, because domestic producers have to compete with foreign competition. And as a result of that, that competition is going to drive prices, domestic prices down as well. As we look at the U.S. economy, there's already evidence of a pretty sharp slowdown in activity in the oil patch. Despite that trouble, the economy will be stronger in the second half of the year. It just takes a while to get there. GDP growth in the first quarter, my estimate is it's going to come in at about 0.6. It won't be much better in the second quarter. You can see my forecast for the second half. Things are starting to improve. Here's what happens when oil prices drop after a long period of strong investment in the sector. Initially, investment plunges in the areas where oil revenue was important. So particularly in Texas, but also North Dakota, Pennsylvania, West Virginia, Colorado, Montana. It's amazing how widespread the fracking revolution had become. And what we're seeing in those areas is that where lending was strong, it's now weakening. We're seeing consumers cutting back on spending because their income is in jeopardy. And we will see housing slow as well. Rents are beginning to roll over in cities like Boulder and Houston, and all of that is a result of this lost income. In the end, the benefit to consumers is bigger than the pain to oil producers. The mining sector is very small in the U.S. It doesn't take very many people to get oil out of the ground, and all of us are benefiting from lower gas prices. Those savings in the last 6 months alone amount to $30 to $40 a week for the average family, which obviously is a substantial amount of money. The thing is that there's no pressing need to spend that money. Where oil companies have already announced tens of billions in investment cuts this year because the price is low, consumers are only slowly beginning to spend their savings. But they are spending their savings, and you can see how that lower gas price is benefiting consumers in the difference between nominal consumption data and real consumption data. So what we're looking at on this slide is the change in the last 3 months compared to the 3 months before at an annual rate. So those diamonds on the chart represent the growth rate, the quarterly growth rate in each quarter. The blue line is nominal. Nominal dollars, of course, that's the money that you pull out of your wallet or put on your credit card when you buy something. The red line is real dollars. That's the value of the goods and services we get in exchange. Nominal spending peaked in the second quarter last year at about 5%. It came down to 4.5% in the third quarter and fell to 3 3/4 in the fourth quarter. But real spending was stronger in each quarter of the year. From 1.25% growth in Q1, we accelerated to 2.5% in Q2, 3.25% in Q3, and 4.3% in the fourth quarter. That's the strongest in about a decade, and it's very likely going to be revised up tomorrow because it turns out service spending in the fourth quarter was stronger than originally reported. Now, you might notice on the far right side of the graph that both of those are falling off a bit. It's not surprising that real spending is slowing again after reaching a 10-year high. But nominal spending has slowed a lot more. This is a bit worrisome. It does indicate that consumers were knocked back. I suspect part of what's going on is that people spent more than they wanted to in the fourth quarter repairing damage done by harsh winter weather, and they may be cutting back a bit. Looking at oil company investment, this chart shows the rig count. That's the number of rigs operating in the United States. Actually, this particular chart is the North American rig count. That's essentially an indication of oil exploration. The red line is oil production. One of the reasons the oil price has risen from its recent low is that the rig count has plunged, and it's likely to plunge further by the end of the year. But you'll notice that production actually lags pretty far behind the rig count. Rig count took off in 2003. That was the bottom. Production took off in 2006. It stabilized, and 2009 it started to rise. So there is a multi-year lag between exploration and production. It's made a little bit more complicated by the fact that fracking wells don't last as long as traditional oil wells. In other words, the supply situation is a bit of an unknown. But what we do know is that there's been, despite a $20 billion drop in capital expenditures, output in the U.S. is still rising. And it's rising because oil companies desperately need the cash flow in order to pay their employees and service their debt. And in fact, looking around the world, production is up in Iran. Iran is fighting ISIS in Iraq. They're fighting the government in Yemen. That's expensive. Russian production is up. They've got a war to finance as well. And in fact, throughout most of OPEC, production is up because they're desperate for cash flow. These are oil inventories in the United States. This is excluding the strategic reserve. You can see we have blown away the last several years in terms of oil in storage. This is being driven by speculators. Right now, the oil futures price rises over time. So speculators can buy oil today, sell it 6 months from now in the forward market, and store it for a nice profit. And that's exactly what people are doing. That will continue until the storage facilities are full, at which point I would expect the price is going to have to drop even further because there won't be anywhere to put it. Storage facilities are at about 80% of capacity at the moment. That's the most full they've ever been. And April, when refineries shut down to retool, is the likely time where we're going to test those maximum capacity limits. So we'll have to keep an eye on that. Obviously, if we were allowed to export crude oil, it would alleviate some of the supply problem. It would also result in lower gasoline prices because at the moment refineries have all this crude to work with. They can sell gasoline and diesel fuel overseas. Foreign economies would actually like to buy the crude oil more than they like to buy the derivative product because it's cheaper to refine it themselves. But for the time being, Congress has made it impossible to export crude. Inflation expectations. This is the break-even rate between 10-year Treasury yields and 10-year TIPS, the Treasury Inflation Protection Securities. Right now, at 1.8%, it is extraordinarily low, at similar levels to where it was in 2011 when the Fed engaged in Operation Twist. So we're seeing tremendous downward pressure on interest rates at the long end of the curve. The primary reason is that inflation is expected to be low. And I think that's smart. What we're looking in this chart is the oil price drop in 1986. That's the blue line, the price of oil on the left axis. Oil fell by about 2/3, and it stayed low for a long time. And it translated almost immediately into a decline in core prices. I think 86 is by far the best example to look at if you're trying to judge what might happen with the oil price decline this time. And the reason is that, like 86, we've had 10 years of very high prices. So we've had a lot of investment in oil. And because of that, like 86, we're going to have a couple of quarters of GDP weakness. In fact, back in 86, we had a quarter of almost no growth. People were worried, economists were worried we might fall into a recession because Texas was so weak after being so strong. It didn't work out that way, but what did happen is we saw a lot of downward price pressure, and it does extend into core prices. The reason is that energy gets into the price of everything. There are the obvious things affected by energy like airfares, but there's also things you might not think of. Floor coverings, for example, paint. All of these things are affected by oil prices. And that brings us to the Federal Reserve. The Fed has been focused almost exclusively on jobs in the last year or so. The Fed, of course, has a dual mandate. They're supposed to target full employment. They're supposed to target stable prices. They define stable prices as 2% inflation. But the key to understanding the Fed's thinking is that they believe inflation only comes from two things in the medium to long term. That is, it comes from labor markets being tight, or it comes from inflation expectations. That's it. That's all that gets into the Fed's inflation models. So when they see jobs being created, when they see unemployment becoming employment, when they see labor slack falling out of the economy, they get nervous. They're less nervous than they were, though. This is the Fed's famous dot plot. I'm sure you've heard of this. They publish quarterly forecasts at the FOMC. The latest one was just last week. And in those forecasts, they show us where members of the Federal Open Market Committee expect interest rates will be at the end of the current year, next year, 2017, and ultimately in the long run. What I did in this chart is we took the March dot plot in blue and superimposed those red circles. That's where the dots were in December. And what happened was the median estimate in 2015 had been 1 1/8%. It fell by 50 basis points. In 2016, the median estimate was 2.5. It's now 1 5/8. And in 2017, the median estimate was 3 3/4. It now looks like it's shaping up somewhere around 3 1/4 to 3.5. So a really significant change in thinking at the Fed. Oh, and by the way, the long-run estimate for Fed funds also is moving downward. It was 3 3/4. Now, if you eliminate the outliers, it's 3.5. Just to illustrate how big that move is, what we've done here, the dark blue line is the most likely path of Fed tightening if the Fed follows an even or as even as possible rate of rate hikes and gets to those year-end targets The year-end targets are marked with red dots. So the dark blue line is the median estimates in March, the light blue, the median estimates in December. You can see how the Fed's expectations have moved downward significantly. And finally, the red lines on the bottom. That's what was priced into Fed funds futures in pink before the meeting, in red after the meeting. So the market moved a little bit, just a fraction. The Fed moved a lot more. And the market and Fed are now essentially in sync in 2015 and very close in 2016. Of course, the Fed is never content to leave well enough alone. This is comments from Fed officials within a couple of days of the Fed meeting. From Stanley Fischer, the vice chairman, we hear that a smooth path upward in the Fed funds rate will almost certainly not be realized. In other words, the 94 tightening, the 2004 tightening, both of those were very smooth. He says we're not doing that this time. There's too many things that could go wrong. What he's trying to say here is don't assume September and December rate hikes. Maybe we go once and wait 6 months before we go again. That seemed to be the message from Cleveland's new Fed president, who said that June is a viable option for rate increases on Monday. Then you've got St. Louis Fed President Bullard saying, trying to explain why the dots moved lower, saying it's only because some of the more hawkish members were hoping to see a rate hike in March. Of course, that's absolutely baloney. You don't see those estimates dropping 100 basis points next year because of something that didn't happen in March this year, but okay. And finally, Janet Yellen asked, gee, you must be at least a little less confident in your inflation forecasts because, inflation is actually going in the other direction. And what would it take to be confident in your inflation forecast? And from the sound of it, they're not really sure, which I think is actually not a bad way as we think about what the Fed is likely to be doing. Not a bad way to think. Here's the thing. The Fed was very bold about tightening until tightening drew close. What we're looking at in this chart is those median estimates for Fed funds at the end of 2015, 16, and 17 from the dot plot and how those estimates evolved over time. In 2014, in late 13 and 14, the Fed was increasingly hawkish. That is, the dots were drifting upward. They became more certain they were going to raise rates in 2015, and then they were going to get downright aggressive in 16 and 17. The dots peaked at the June 2014 meeting, and I think the reason they peaked at that particular meeting is that was the first time the Fed was forecasting rate hikes that were likely to begin within a year. 5 rate hikes predicted by the end of 2015 meant that by any reasonable measure, they were going to have to begin in March of this year. And the markets reacted to that. If you look at the Fed statement, it was absolutely benign. But it is the dots moving in that statement of economic projections that prompted the markets to reprice the likelihood of aggressive tightening. After June, the dots have fallen at every meeting, and I don't think that's a mistake. It's one thing to be aggressive, to be confident when something's a long way out. They're getting cold feet now that they're getting closer to the day. They're also getting cold feet because their forecast is evolving. What you're looking at here is the range of GDP forecasts by the Fed, going back to 2012 in red, then 2013, 2014, and 2015. There are 4 forecasts in each period, except for the current one, because, of course, we've only got the first quarter. But what you see is the evolution of their growth forecast. It has gotten consistently weaker and flatter over time. It's almost as if the Fed has come to terms with the new normal. And I think one reason for that is that the Fed is beginning to realize that the GDP data are a bit deceptive. If you look at the quarterly data, particularly when we were standing in the fourth quarter and we're looking back at third quarter GDP growth of 5%, the strongest in a really long time, it's easy to draw a trend line like I have on this chart that rises over time. There was this idea that growth begets growth, that strong growth now means stronger growth later. But, of course, if you look back at this chart, what you realize is, wow, the fourth quarter of 2012 was almost zero. You know, there's a negative quarter in 2011. First quarter of last year was not just negative, it was deeply negative. And when you look at year-on-year growth, it's essentially flat. So this is the change in GDP from the same quarter a year ago. I drew it on the same scale as the previous chart. And here, the trend is pretty clearly flat. Growth is 2 to 3%, and lately it's been 2 to 2.5%. The Fed's, those on the Fed who believe growth is going to accelerate to 3 are perennially proven wrong. And if you pull back and look at a longer sweep of time, what you realize is that GDP growth now is quite weak compared to the last cycle, and even weaker still compared to the 1990s. Growth is decelerating. And yet the Fed has decided that our economy really can't stand growth any faster than what we're seeing now. It can't be any faster because there's no growth in productivity. And that means that an acceleration in GDP growth would strain the labor markets excessively. I think that's probably wrong, by the way. We don't know for sure where productivity growth comes from. But what we do know is that if you're going to increase productivity, which is output per worker hour, it requires investment. And it makes sense that companies haven't invested very much in productivity growth recently because there's an ample supply of labor. In fact, looking back, the last time productivity growth was as weak as it was last year was in the early 1980s, in the aftermath of the 80s recessions, when there was also a ton of labor slack. Where I think the Fed's forecast really falls apart is here. This is the forecast for inflation, ex food and energy. You can see that reality, which is that black line, saw prices fall, or inflation fall, from close to 2% in 2011 to a little more than 1.5% in 12. A little more than 1.25% in 13, 14, and 15. It's currently running at 1.3%, and yet the Fed has forecast a return to 2% inflation within 2 years since 2013. This year, the concession is that it'll be low in 2015, but then we return to 2% within 2 years. Clearly, if the Fed's forecast is going to be wrong, it's a lot more likely to be wrong on the inflation side than it is on the growth side. And that's important. It's the primary difference between what the market is betting and what the Fed is betting on Fed funds, right? Because if inflation stays low, there's no need to tighten nearly as aggressively. This is the U.S. dollar, the value of the trade-weighted U.S. dollar. My assistant, Sophia, marked all the Fed meetings from 2012, the beginning of 2012. You can see the dollar was pretty benign in 12 and 13, not doing much, not much movement until June of last year. And again, that's that peak dot plot forecast. In June of 14, that was when the markets became convinced the Fed was tightening. As it turns out, it's also when the ECB signaled quantitative easing this year. And it was really that combination. The easing in Europe, which has prompted easing, as I mentioned earlier, in 20 different countries, as they try and protect themselves against the plunging value of the euro. And the result is that the dollar has strengthened by about 20% from that low point. Dollar has weakened a bit in the last few days. I wouldn't expect that that's going to last. I think this is a little bit like the very beginning of the year, where we're consolidating before moving upward again. Our interest rates are relatively high compared to the rest of the world. You can see Europe on the far left in this chart with negative yields. Japan at 0. Portugal, amazingly. Spain, well below 1%. Italy, well below 1. And there's the U.S., just barely higher than Canada. And the reason we're higher than Canada is that we're threatening to tighten. Canada's not. And the next highest, again from Bloomberg's World Bond page, is Mexico. It is a remarkable state of affairs. So why are our yields so much higher? Well, partly because the European Union's QE program has driven down yields significantly. Switzerland has those deeply negative yields, the Netherlands too, in a deliberate effort to drive capital out of their economy. They're trying to chase money out because they're trying to weaken their currency so that they don't fall into recession with the euro so much lower in value. As for the EU, the reason those yields are so low is that banks have to hold government debt or significantly increase the amount of capital they hold. And they're willing to do that even if it means that they are holding less, earning less than a positive rate of return. Job growth is slowing, and job growth is strong. Got a little slide snafu here again. See if I can, there we go. Get them back up. Job growth is strong, but job quality is not. If you look at the number of people working part-time, that is extraordinarily high. And the lack of participation is also quite high. Private debt as a percent of GDP is falling. This is something we've never seen before when the Fed is tightening. And so let me round up the conclusions here. I suspect we've lost the slides again. In conclusion, global growth is sluggish. Global growth is likely to stay weak. for some time, and that puts downward pressure on prices. Nevertheless, in the U.S., despite the fact that we're starting to import deflation, the Fed is putting discipline and dependence on models above all. Why are they planning to tighten? It's because their inflation model tells them they're going to have a real inflation problem in 2018 if they don't start normalizing rates today. I think liftoff is likely in the third quarter. It's probably going to be September, but it could be as early as July. And that tightening is going to contribute to global strains. That is, we're going to see the dollar continue to strengthen, and that is going to continue to put pressure on emerging markets, which peg to the dollar. The Fed could pause at any time. They could stop raising rates at 1. I think Stan Fisher is a particular fan of this. He and Janet Yellen seem to see eye to eye. I hope that's what they do. The market thinks they're going to 2%, and that's as high as they're going to get. I predict if they go beyond 2, then they're going to have to cut rates in 2017. The market is still quite interest rate sensitive. All right. I think that's a good time to open it up for questions, please.
At this time, I'd like to let everyone know to ask a question, please press star and the number 1 on your telephone keypad. It may take a few moments to compile a Q&A roster. Again, it is star and the number 1. And there are no questions. There is actually one that just came out from Ashley Nedcott at Merchant and Farmers. Your line is now open.
Chris, how do you see what do you see the yield curve doing going forward as the Fed begins to raise rates?
Well, the normal thing would be that the long end should sell off even more than the front end for about 3 months before they start tightening and about 3 months after they start tightening. And the peak in 10-year note yields should be about, I would think, about 2.5%, maybe even as high as 2 3/4, at which point the curve would flatten, as short rates come up to those higher long rates. But I'm not entirely convinced you're going to see the sell-off at the long end. In fact, our fair value work based on a $60 oil price at the end of the year and inflation accordingly, low, says that the 10-year note could be as low as 210 at year end. In other words, pretty much where it is now. So for that reason, it's actually likely that the Fed, when it does tighten, the flattening could begin almost right away. And that's partly because if U.S. yields do rise, they're going to be very attractive to overseas investors, particularly foreign central banks, who are big buyers of 2 and 5 year securities, but also will come in and buy those longer dated notes to get some return.
And your next question comes from the line of Albert Cruzman at, the company name is not audible. Please state your company name as well with your question.
Yes. What do you think the increase in interest rates, should that occur, what do you think the impact will be on the U.S. fiscal policy?
That's a great question, right? Because obviously interest on the debt right now is extraordinarily low, and it's going to rise as rates come up. We actually did a calculation of what that would mean to the cost of debt service for the purpose of this calculation, we figured let's see what happens if the Fed raises rates to 3 3/4, which is what they were threatening to do in December, and let's assume that 10-year note yields rise to 4%. So in other words, the return of normal in exactly the fashion that the Fed has been predicting. And what we found was that interest on the debt, which is currently about $250 billion a year, would rise to about $800 billion a year over the next 5 years, and that sounds extraordinarily high. But as a percent of GDP, it's actually about the same as it was in the mid-1980s. In other words, our ability to service the debt has been even worse than that in the not-too-distant past. Of course, if you remember what was going on in the mid-1980s, it was one of the few times where there was so much pressure for fiscal reform that we actually got stuff done. That was when Graham-Rudman-Hollings passed and so on. So I would expect that as the Fed raises rates and that interest cost starts to come up, we're going to see Congress become a lot more frugal, even than they are today.
And we have no further questions.
All right. Well, thank you very much for joining us today for the 2015 Economic Update. I will share the slides with FHLB if people would like to get a copy of them. And appreciate the opportunity to be here this afternoon.
And on behalf of Federal Home Loan Bank of Dallas, a big thank you to Chris Lowe. That was great. Thank you so much.
You're welcome. Thank you.